Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today I will be talking about a Japanese stock that was suggested by a subscriber, and it is also one of the stocks that Monish Babrai has in his portfolio. That stock is called Shinoken Group. Shinoken Group is a real estate company which is a one-stop shop for folks who want to become landlords. So let's say you're in Japan and you want to become a landlord, but do not want to worry about the hassle associated with finding renters, the fact that you have to worry about the renters paying rent, then all the maintenance costs associated with upkeeping your apartment or condo. In that case, you would just go to Shinoken and buy your apartment or condominium straight through Shinoken, and then Shinoken provides all these management services such as finding renters, guaranteeing that you'll be getting rent from those renters, and also lately they have been into liquefied petroleum gas and retail electric services that they provide to these renters. So in short, if you want to become a landlord, then Shinoken is this one-stop shop that you buy your apartment or condo from Shinoken, and it provides all these other services that take care of all the hassle associated with being a landlord. So today we'll briefly go over the company's business, focus on the company's fundamentals by reviewing the company's key ratios, and finally find the intrinsic value of the company. So let's dive in and review Shinoken Group.
Hey guys, let's quickly go over the company profile. Shinoken Group Company Limited is a Japan-based company engaged in real estate sales business, real estate management related business, general contract business, energy business, nursing care business, and foreign operations. In the real estate sales business, the company sells apartments and condominiums. The real estate management related segment includes activities such as rental management, condominium management, real estate fund, and others. The energy business segment includes liquefied petroleum gas and electricity retail sales activity. Now that we have a brief understanding of the company's business profile, let's go over the company's key ratios to better understand the company's fundamentals. Over here, I'm on Morningstar looking at Shinoken Group Company Limited. Under key ratios, I have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company brought in about 19.8 billion yen. And for the year 2020, that number was about 95.2 billion yen. Shinoken's revenue was increasing every year from 2011 all the way through 2018. However, over the past couple of years, that is in 2019 and 2020, the company's revenue has plateaued out. The plateauing of revenue is primarily due to the pandemic. The company expects the company's revenue to rebound once it does recognize the sales on its real estate properties. Next, looking at the operating income. The operating income is what's left with the company once we subtract the operating expenses from the company's revenue. Back in 2012, the company's operating income was about 1.3 billion yen, and for the year 2020, it was about 8.9 billion yen. The company's operating income has a similar trend as the company's revenue, as the company's operating income peaked out back in 2017 and has been on a decline ever since. However, we do see that the company's operating income has always been positive and that the company's operating margin has ranged from 6.6 to about 13%. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it had paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2011, the company's net income was about 1 billion yen, and for the year 2020, it was about 5.95 billion yen. Shinoken's net income over the past 10 years has a similar trend as the company's operating income. We do see that the company's net income peaked out back in 2017. However, the company's net income every year for the past 10 years has been positive, which tells us that the company always reported a profit over the past 10 years. Next, looking at the dividends per share. Back in 2011, the company paid out about 1.38 yen per share as dividend, and for the trailing 12 months, it was about 38 yen per share as dividend. Over the past 10 years, the company's dividend per share peaked out back in 2018 when it paid out about 45 yen per share as dividend. As the following year, the dividend per share dropped down to about 30 yen per share. However, ever since then, the company's dividend per share has been increasing. Next, looking at the payout ratio. This ratio compares the company's dividends to its income, so it gives us an idea of what percentage of the company's income is actually being paid out in the form of dividends. Back in 2012, the company's payout ratio was about 6.4%, and for the trailing 12 months, that number had increased to about 24.2%. What this means is every $100 that the company made in income over the past 12 months, it paid out about $24.2 in the form of dividends to its shareholders. And such kind of dividend payout ratios are certainly sustainable for a long time. Next, looking at the shares outstanding. Back in 2012, the company had 34 million shares outstanding, and for the trailing 12 months, the company had about 35 million shares outstanding. The company's shares outstanding number has stayed consistent ever since 2014. This tells us that the company is not issuing more shares and diluting the existing shareholders' ownership within the company. After that, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. So book value is the same as the shareholders' equity. Back in 2012, the company's book value per share was about 62.68 yen per share, and for the trailing 12 months, that number had increased to about 1,247.17 yen per share. Ideally, we want to see the company's book value per share to be positive, staying steady or increasing. And we can see that Shinoken's book value per share has been positive and increasing every year for the past 10 years. This tells us that the company always had more assets than liabilities on its balance sheet, and also the proportion of the company's assets to its liabilities is increasing. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract the capital spending from the company's operating cash flow. Back in 2012, the company's free cash flow was about 1.6 billion yen, and for the year 2020, it was about 10.9 billion yen. Over the past 10 years, the company's free cash flow has been volatile, as we can see that there were a few years when the company's free cash flow was negative. This was primarily because the company's operating cash flow over those years were negative. This happens when a company buys a lot of inventory, which drags down the company's operating cash flow, which eventually leads to negative free cash flow numbers. And because of this volatility, I will be using the average of the past 10 years of free cash flows for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Back in 2011, the company's net margin was about 5.05%, and for the year 2020, that number was about 6.25%. What this means is every $100 that the company made in sales in the year 2020, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $6.25 left as pure profit. Ideally, we want to see the company's net margin number to be a high positive number because we want to see majority of the company's revenue to actually result in profit. Next, looking at the company's return on equity. This number compares the company's income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Back in 2011, the company's return on equity was about 80.40%, and for the year 2020, it was about 15.10%. Over the past 10 years, the company's return on equity has always been greater than 8%. There were a few years when the company's return on equity was excessively high. This is primarily because the company was leveraged and had a lot of liabilities, which leads to the company's equity portion to be a tiny number. So when we compare an income to a tiny equity portion, we're bound to get really inflated return on equity numbers. Next, looking at the company's return on invested capital. This number gives an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2011, the company's return on invested capital was about 10.12%, and for the trailing 12 months, that number is about 7.30%. Shinoken's weighted average cost of capital, also known as the company's hurdle rate, is about 4.57%. And since the company's return on invested capital is greater than the company's weighted average cost of capital, we can safely say that the company's management is creating value for its shareholders. Finally, looking at the company's interest coverage. This number compares the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest obligations using its income in that calendar year. Back in 2011, that number was about 2.93 times, and for the trailing 12 months, that number is about 22 times. Benjamin Graham, the father of value investing, preferred to only invest in securities that had an interest coverage of 5 times or higher. Now let's look at the company's financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want the company's current ratio to be greater than 1.0. It's even better if the number is greater than 1.5. A current ratio greater than 1.0 tells us that the company has enough current assets to fulfill its current liabilities. Back in 2011, the company's current ratio was at 1.09, and for the latest quarter, that number is about 2.58. The company's current ratio over the past 10 years has always been greater than 1.0. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. A quick ratio greater than 1.0 tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2011, the company's quick ratio was at 0.30, and for the latest quarter, it's about 1.37. The company's current and quick ratios for the latest quarter indicate that the company is not in a liquidity bind. In other words, it is liquid enough to survive for the next 12 months. After that, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to its shareholders' equity. A financial leverage of 1.0 tells us that all of the company's assets are financed via shareholders' equity. A high financial leverage ratio tells us that the company is taking on more debt and is taking on liabilities in order to buy those assets. Back in 2011, the company's financial leverage was about 9.35, and for the latest quarter, that number has dropped down to about 2.25. Over the past 10 years, the company's financial leverage has slowly been decreasing, which is certainly something we want to see as shareholders. Next, looking at the debt to equity ratio. This ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt to equity ratio to be less than 1.0. It's even better if it's less than 0.5. Back in 2011, the company's debt to equity ratio was at 1.81, and for the latest quarter, it's at 0.48. Similar to the trend that we saw with the company's financial leverage, the company's debt to equity ratio has also been decreasing over the past 10 years. So just by looking at the company's financial leverage and debt to equity ratios, we can say that the company is a lot less leveraged now and is in a much better shape financially now than it was 10 years ago. Now let's look at the company's efficiency ratios. The first item on the list is the day sales outstanding. This number gives an idea of how many days go by from the day the company recognizes its sale to the day it actually receives cash for that service rendered. Back in 2011, the company's day sales outstanding was about 18 days, and for the year 2020, it was about 30 days. Ideally, we want the company's day sales outstanding number to be staying steady or decreasing. What we do not want to see is a day sales outstanding number that's growing exponentially, as that tells us that the company is being aggressive with its accounting, as it's trying to recognize its revenue sooner so that it can inflate its income numbers on its income statement. In the case of Shinoken, we do see that the company's day sales outstanding number has been growing. However, it's not growing at an exponential rate where it's a cause of concern. Next, looking at the days inventory, this number gives an idea of how many days does the company's product sit in its inventory before it's sold. Back in 2011, the company's days inventory was about 151.5 days, and for the year 2020, it was about 90.75 days. Ideally, we want the company's days inventory number to be staying steady or decreasing. In the case of Shinoken, the days inventory has hovered in the 90 to 150 day range. Next, looking at the payables period, this number gives an idea of how many days does Shinoken take to pay its suppliers. Back in 2011, the company took about 36 days to pay its suppliers, and for the year 2020, it took about 32 days to pay its suppliers. Over the past 10 years, the company's payables period has stayed fairly consistent. What we do not want to see is a company whose payables period is growing exponentially, as that tells us that the company is trying to hold on to its cash in order to artificially inflate its cash flow numbers on its cash flow statement. However, in the case of Shinoken, we can safely say that the management is not playing any such accounting tricks. Finally, looking at the inventory turnover, this number gives an idea of how many times does the company's inventory go through its system in a calendar year. Back in 2011, the company went through its inventory about 2.41 times, and for the year 2020, it was about 4.02 times. Ideally, we want the company's inventory turnover to be staying steady or increasing. And we can see that over the past 10 years, the company's inventory turnover has stayed fairly stable. Now let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Shinoken's PE is at 7.5, whereas S&P 500 is at 24.1. Shinoken's price to book is at 0.9, whereas S&P 500 is at 4.3. Shinoken's price to sales is at 0.5, whereas S&P 500 is at 3.0. The company's price to cash flow is at 5.2, whereas S&P 500 is at 17.2. And finally, the dividend yield. Shinoken has a dividend yield of 3.2%, whereas S&P 500 has a yield of 1.5%. So in all these valuation metrics, we can see that Shinoken Group is undervalued when compared to the S&P 500. Now let's look at Shinoken's discounted free cash flow DCF analysis. Over here, I pasted the company's 10-year average free cash flow that I got from Morningstar, which was about 3,281 million yen. I'm assuming the annual growth rate of free cash flow to be 6%. What this means is I expect the company's free cash flow to grow at 6% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate of 4%. What this means is after the 10-year mark into perpetuity, I expect the company's free cash flow to grow at 4%. The company has 35 million shares outstanding and has a long-term debt of 19,421 million yen. I got this number from the company's balance sheet. After taking all of these inputs into account, we get the company's intrinsic value to be about 1,295 yen per share. And when we compare this intrinsic value to the company's current stock price, which is about 1,173 yen per share, we can see that the company's current stock is trading about 10% below the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about 26.9 billion yen. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about 64.75 billion yen. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about 1,295 yen per share. Now, if we disregard the perpetuity component, in other words, if you think that Shinoken is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about 214 yen per share. And if we disregard the debt, in other words, if we think that Shinoken is going to grow into perpetuity, so there's no point for the company to worry about its debt, then we get the intrinsic value without the debt to be about 1,850 yen per share. So to sum it up, Shinoken has strong fundamentals. It is an undervalued security, not only from a discounted free cash to DCF analysis standpoint, but also when we looked at the company's price to earnings ratio and price to book ratio, we could see that the company's stock price is cheap. Shinoken's president, which is similar to an American company's CEO, owns about 17.8% of all the shares outstanding. So we know that the company's management has a vested interest in the company and that whatever decisions it takes is also going to be beneficial for its shareholders. And lastly, we have a famous value investor like Monish Pabra invested in this company. And it makes sense because Shinoken provides this value to the community where if you're an individual interested in investing in the real estate market but don't know and don't want to deal with the logistics associated with finding renters, what you do with maintenance and so forth, Shinoken is that one-stop shop where you can go to Shinoken, buy the property, and then Shinoken will take care of the rest. So in short, Shinoken's business model is easy to understand. Its management's incentive aligned with those of the shareholders. We have stamp of approval from a famous value investor like Monish Pabrai. And it is an undervalued security with strong fundamentals. Hey guys, that is all I had for you this week. Hopefully you found this video on Shinoken interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which Japanese stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.